Revolution Acceleration Acquisition Corp, or RAAC SPAC, is merging with Berkshire Grey. The deal is expected to close in the second quarter of 2021. Now, what is Berkshire Grey? They're looking to revolutionize the automation of warehouses, and they've already landed some major customer contracts like Walmart, Target, and FedEx. The PIPE is also being led, so that's a private investment placement, is also being led by Chamath, the SPAC king. So management expects Berkshire Grey to grow by 26-fold in the next 5 years. So incredible hypergrowth, and which, if they could deliver on that level of growth, could mean a home run for Berkshire Grey shareholders and by proxy the Revolution Acceleration SPAC, if the deal does indeed close. Advanced warehouse automation does seem like an obvious direction for humanity. The question is whether Berkshire Grey is the obvious winner. To that point, this video goes out to Unrivaled Investing Journey subscribers, about which let me give a quick 10-second plug, if you will. My name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, make a point of subscribing. And if you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey to see what potential multi-baggers I'm buying, go to unrivaledinvesting.com, click on Journey. So, what is the deal as we look at Revolution Acceleration Acquisition Corp, RAAC SPAC, which is merging with Berkshire Grey. I don't think they put out a ticker symbol quite yet. Expected to close second quarter of 2021. You get around $300 million in cash from the SPAC itself, then another additional private placement led by Chamath of another $165 million. You can see the vast majority of this $400 million plus cash is going to the balance sheet, and then the rest is just covering fees and expenses. They do have some other notably interesting investors with Coslaw Ventures, SoftBank, and Steve Cass, who's running the SPAC is Steve Cass. So, and he was one of the founders of AOL. So what is Berkshire Grey as we dig in? And it's really the next generation of warehouses, where it's all about using software, hardware to automate warehouses. You have these bots moving around super fast, carrying these bins with different items, being able to quickly pick up these bins, endless conveyor belts. And what's the one thing you notice here in this picture? Not a lot of people. And so what exactly does that mean? So you have like automated robot picking. So robots picking up items from bins. And keep in mind, that is hyper complex. You don't know how much pressure you're supposed to put. How are you supposed to hold it? Should it be upright? Should it be like this? Then intelligent robotic mobility. All these different units scattering around throughout the warehouse. Oh, but you got to orchestrate where they're going. You can't have them collide if they're going super fast. Then sophisticated robotic perception, like what is the item that we're looking at? Does this match what we're looking for? And so you're layering in not only really complex hardware, like, hey, let's pluck this thing up and move it from point A to point B, but also this really complex like orchestration and ultimately software. You're looking at artificial intelligence. So it's this marriage of really complex hardware, really complex software coming together to create the next generation of warehouses. And they have a bunch of different product models trying to solve customer needs for picking, packing, and delivering for commerce, whether or not it's e-commerce, grocery, store replenishment, a lot of different, potential verticals. We'll get into that in a little bit in just a second. So what's the value proposition to the end customers? And it's primarily about cost savings. At least that's the big theme that you'll hear, where they say, look, the return on investment, you get a full return on investment over 2 to 3 years, but you see this key aspect, a 70% reduction in labor spend through robotic picking and intelligent mobility. Hence the pictures you just saw. You didn't see really anybody in those pictures. Here's an interesting comment. Throughput of one Berkshire Grey solution equal to that of 8 manual pickers and hundreds of case handlers. So the cases are just moving around because they have these little bots that are able to do it. And at maximum reliability and accuracy, you don't have to worry about, hey, this guy hurt his back and he doesn't want to move these cases anymore. It's someone called in sick. Oh, the bots can do it. It's a very cold way of looking at it, but these businesses are looking at it from a return on investment perspective. So it's primarily about cost savings, but it's also about table stakes of saying, hey, are we offering what our competitors are offering? And could we potentially turn this into a revenue generator where it's like, hey, do you want same day delivery? Maybe that's not something that, let's say, Target or Walmart currently offers in an easily way. Now you can potentially do that and potentially increase your revenue for these major customers if you have much more efficient warehousing. So how do they actually pitch it to the customers? Because this is how they pitch it to investors. How do they pitch it to the customers? Because that might be something else, and you can see how it's slightly different as you go to their website, where they say get started with Berkshire Grey, reduce operations expense by up to 70%. So that's a big aspect. Reducing your warehouse operating expenses by 70%, lessen your dependency on labor, and bolster facility throughput by 25 to 50% with automation, i.e. things are just moving a lot faster. You don't need to necessarily open up a new warehouse. Let's say you have 2 and you were planning on opening a 3rd. Well, wait a second. If you can get 50% automation improvement, throughput improvement because of automation, that's equivalent of another facility. Now you don't have to spend that money on building a whole new complex. What if your existing warehouses could deliver that much better improvement? So people will start thinking about it from an opportunity cost perspective. Hey, this could be a revenue generator. Hey, I don't need to spend as much on costs going forward, and I won't necessarily need to build out a whole new facility if we make the investment up front on using Berkshire Grey's technology. So then what's the opportunity that you're tapping into? Clearly, it's huge, enormous. You're looking, management says 280 billion plus total addressable market, primarily of which it's annual warehouse labor spend, i.e. all these folks that are working in the warehouse, like, you're gone. But they are saying a good chunk is also material handling expense of 56 billion. So i.e. the actual equipment you need in warehouses, that is part of the market that they're going to be selling into, because instead of, let's say, needing a forklift, you're going to need the Berkshire Grey equipment, the bots that can easily zip things around the warehouse. I think this is an interesting look at the opportunity, but I honestly view it through a different lens. Clearly, it's huge, enormous. That's not a question. I think you should also consider viewing it from this angle, which is that 5% of warehouses are currently automated, of which the vast majority is Amazon. And this is really about arming the rebels, or at least that's how Shopify spins themselves, of arming the rebels. This is sort of like arming everyone that's not Amazon to try to catch up. Like, Amazon's already doing this. They already made the investment several years ago in Kiva Systems, a robotics company. They have over 200,000 robots in service today. Like, they're plowing ahead. They know this is the future. They know, hey, let's push this to the metal. And so, pedal to the metal. And so, this is everyone, the wake-up call for Walmart, Target, FedEx, all saying, man, we didn't make that investment in robotics. We need to do that. So who are they targeting? So that all these, competitors, whether or not it's a delivery company to grocery to, retailer, that all compete with Amazon, that need a level playing field in terms of warehouse, logistics. Who are they potentially targeting? And you see it's a wide range of different verticals, whether or not it's retail, e-commerce, grocery, parcels, and third-party logistics companies. And so you can see, and you can see some of these major anchor customers that they've won. I mean, this should speak volumes about the business potential. The fact that they've got at least these toehold investments or purchases from these customers. So that's really interesting. That said, I wonder if it's indeed prudent to target all these different verticals at the same time, especially when the company's so early on, because at the end of the day, like, working with a grocery company where you have frozen goods and goods, shelf-stable goods, that's very different than, let's say, a third-party logistics company, which is going to be very different than a e-commerce platform or a retailer, that's moving, clothing or something like that. So I just wonder if they might be spreading themselves a little too thin by having so many different verticals. I wonder if it makes more sense, instead of having a bunch of anchor customers, which is generally viewed as a good thing. Like, normally I'm like, that's great, but I wonder if it would actually be better to have like one major anchor customer that they're really going deep on, saying, hey, we are going to own e-commerce going forward, and we're figuring out all the challenges here, because the reality is there are different challenges for each of these verticals, and they're sort of calling that out. Consumer expectations for retail are going to be different from grocery, which is different from parcels. So it is a little bit of a question for me of, like, does it make sense to try to target all these verticals at the same time? Now, they are saying, like, look, because we've already won these major customers, we do have visibility to $1.3 billion in revenue over the next 5 years, which is pretty incredible. That said, there is a difference between actual contract pipeline versus visibility. And they do mention that their orders to date is only 114 million, but that's still great for pretty much a venture company that's only tens of millions in revenue so far for the business, cumulative for their history, and 70 million current total backlog. But they are saying, look, the visibility is over $1 billion. And you can see how that translates into, what their revenue potential is over time. And I'll shrink myself a little bit, where they're saying, look, in 2020, we did about 35 million. And this is the way to think about this is initial orders for the system. And they're expecting to rapidly ramp that up to 927 million in the next 5 years. So, I mean, that's this 26x growth from 2020, which is just incredible. Also, the potential of landing new customers. That's this dark blue of like, hey, can we start landing these new customers? But they are saying longer term that they're going to be effectively a recurring revenue business like robotics as a service, or services of like, hey, let's just make sure there's monitoring or maintenance of the facilities that we help set up. That said, like, while that sort of recurring revenue business does strike one as super sexy, like, hey, you are now ingrained in, let's say, Walmart's warehouse, that's going to be really great recurring revenue over time. One should recognize what they are forecasting, which is that this is primarily one-time sales of building out the warehouses. These recurring revenues, this robotics as a service and services, that's this lighter blue or navy blue and green. That is a teeny tiny fraction of the total. So the vast majority of this is just getting sort of set up with their initial customers over the next 5 years. But clearly they think this is a huge market. They have already mentioned 240 billion plus opportunity. So, how does this translate into their financials? First of all, recognize this is a hyper growth potential business, and it's also very early stage business where, 35 million revenue in 2020, going to 927 by 2025. That's their estimates. That's their potential. That's management's potentials. And one should recognize that oftentimes management is putting on the more rosy figures because they want to get the deal done. They want to be able to raise funds and attract a valuation. So you do need to understand that. That said, they did put up some monster growth in 2020, 337%. They are penciling out nearly 70% growth in 2021. But there are some aspects of this business model that, as you'd expect, need to get proven out. For example, their gross margin is very low. It's single digits right now, and they're projecting it to actually dip a little bit in 2021. But they're saying, hey, within the next few years, it could be up to 50% gross margin, which is a little tough to get your head around, especially given the fact that we just looked at this chart, and the vast majority of their sales are still effectively these setting up this implementation versus their recurring revenue business. So it is harder to underwrite, like, hey, you are going to get that margin expansion when it's still sort of the setup phase for new customers. That said, if they're able to get to 48% gross margins, they think they can easily get to 25% EBITDA margins, which flow through pretty well to their free cash flow. So effectively, this SPAC, the cash they're raising, should ideally cover the next few years, which is very material cash burn, let's say averaging around 100 million a year. So this 400 million plus that they're raising, every cent of it's needed. And they're hoping that by 2024 that they turn a profit so they don't need to raise any more. I'm a little skeptical that this will be the last time they raise. I suspect they'll probably need to raise more, just because when you're facing 100 million plus cash burn and you only have 400 million on the balance sheet, and by then it'll be 300 million on the balance sheet. You might start sweating a little bit. So that's just my thought process. So you might see an additional equity raise in the future. And it's also, this is very much a venture bet. They need to prove their operating structure, their leverage, what they can do in the future. That they can indeed go from these gross margins to, nearly 50% gross margin in the years ahead. Now, what are my thoughts on the valuation? So I'm going to take what management gave, and I'm going to put that in my high scenario, then I'm going to do some sort of more moderate or conservative scenarios for the base and low. This is part of my value proposition to my loyal YouTube subscribers, so I'll put this sheet in the description of the video. You click on the link, and you could, play around with the sheet yourself. So, currently the stock price is up a little bit on the deal announcement, so now it's around $13 or around a 30% premium to the deal. This share count is based on the presentation. There's a little footnote that says additional shares that needs to get included. So you need to look at the current price for the SPAC multiplied by the pro forma share count to get what is the pro forma market cap for Berkshire Grey when you're thinking about what your potential returns could be in the years ahead. Now, keep in mind, I'm trying to apply a logical framework to how to think about stocks. Sometimes, it's like, hey, let's just push this thing to the moon. And there's a lot of, animal spirits going on right now where people are like, hey, I don't really care about analysis. I'm gonna buy it now and I'm gonna sell it, and maybe Kathy Woods will buy it. And you get people trading where it's like, hey, I bought it and I sold it, and they haven't even announced any change in fundamentals, and it's all just based on, hey, can I play a better zero-sum game than everyone else, which is effectively like sitting at a poker table and saying, hey, I just think I can do better than others on this change in price, on this change in valuation. I personally rather play a additive game, which is not zero-sum. Additive is not based on just valuation. It's based on fundamental growth over time. So if you find yourself, hey, I'm just trading in and out, that's a zero-sum game. You're like someone sitting at the poker table, and it's a zero-sum game. Like, hey, not everyone's going to win at that. And so I prefer games where it's like, hey, you can have multiple winners here as the companies grow over time. As I look at this, let's walk through some of the scenarios. Like, one is, you have this 337% growth for 2020. They are penciling about 70% growth for 2021, so I'm using that in the high side. They are saying long-term EBITDA margins of around 25%, so I'm putting that in for the optimized margin. I put in 20 and 22.5%. And you can see my low and base is just a slight discount to the high side for next year. But you can see the pro forma earnings for this is very, very high. Now keep in mind, I use an optimized margin figure because I'm saying, hey, what is the margins at maturity? That way your return as a shareholder is the delta between the revenue growth over time. That way, if you're saying, hey, this is being valued by these types of margins in 5-10 years from now, the delta for your investment return is the change in revenue growth. That's why I like using optimized margins. Even if they're nowhere near it now, it's how people are going to think about it in the years ahead in terms of what's the structure here. Now, keep in mind, there is inherently more risk when you have this type of setup, because you can have periods where people have less confidence that you actually deliver on these margins over time, and that creates a significant amount of volatility. Because all of a sudden people say, oh no, you had a bad quarter, maybe you only expect 15%. That change alone can drive, let's say, a 50% drop in a stock price. So that's why you have high volatility in unprofitable companies that have yet to prove their their optimized margin structure. So then, you look out, what's the growth trajectory over the next few years. This is approximately based on management's target. I'm saying 927 million by 2025, which is pretty much on point for what they were saying. And then, discounts. So one is 65%, one is 80% over the ensuing 4 years. So in total, a 5-year period. I prefer looking at things over 5 years because in any given year, crazy things can happen. But over 5 years, I feel like you're more likely to get closer to a full market cycle dynamics, where if something sells off, there's a chance that it recovers. Not always, but it's possible, quite possible. And so then what's the end multiple assumption? Well, hey, if you're just hitting it out of the ballpark, for 5 years and you're compounding at this rate, maybe, you have a 40 times multiple because they're like, this is super sticky and you're supplying the Walmarts of the world with warehousing solutions. Like, let's put 40 times 5 years, and then you're looking at nearly 100% upside. Now, one could argue that I'm being too conservative here on this 40 times and saying, look, if you're still growing at 80% a year, maybe this should be an 80 times multiple. I leave that to you to play around with the assumptions of this sheet if you'd like. So then on the lower side, look, if you're not delivering crazy high growth, and let's say it starts going down to 40, 50, 30% growth, 5 years from now, and that's a question mark. Of a lot of this is rolling out new customer sales versus that recurring revenue business, which, look, they even here, this recurring revenue piece is still very small, despite knowing that they have landed some major customers. So is it possible you still have a lower margin and lower multiple, in which case you have downside of about 60%. So, I look at this and I sort of say, like, meh, risk reward, like not crazy compelling. It's an interesting setup, but not crazy compelling risk reward. If you wanted to get more aggressive on what you thought the end valuation could be in 5 years from now, then you could say, hey, then maybe that starts tilting a little bit better. I personally think I can find better risk rewards, and Journey subscribers know all about that. So let me do a quick Berkshire Grey summary. First of all, they strike me as a very promising venture. It's growing over 300% in 2020. Their growth rate is guided to be much slower in 2021, so maybe they're sandbagging that. So maybe this growth rate should really be like 90%, but they're just sandbagging it right now. That said, warehouse automation is clearly going to happen, I would think. It's a big cost center, and could they automate it and result in much lower costs, 70% cost reduction? So I think this is a obvious trend that's going to happen. The question is it obvious that Berkshire Grey is going to be a winner? They've clearly won some major customers, the Walmart, Target, FedEx, TJ Maxx. This suggests they have the potential for real value in the future. They have a real value proposition now. I'd love to see a little bit more on that. But their growth projections are simply astonishing, as they expect revenue to increase by 26x over the next 5 years. So that's really incredible. I do have actually a bunch of additional thoughts. This video is already running on 20 minutes, but I'm going to save that for exclusively for my Journey subs. So that'll be an exclusive post that I'll leave in the comments below if you want some additional thoughts that I have on the setup, on whether or not I'm going to get involved in the situation, and what are some of my concerns, and what are some of the things I think people might be overlooking in the setup. So that's one aspect that I offer to Unrivaled Investing Journey subscribers. But I also just did a post. However, the stock market's been a little volatile recently, where a lot of fast-growing companies have fallen, 10-20% in just a couple of days. So I did two posts, one on narratives, on how I think there's a potentially changing narrative that could be impacting all these high-growth companies, and how it could potentially impact their valuation, in the immediate term, potentially over the next few years. So that's one thing. I also did another post on buying the dip, and what one potential multi-bagger that's already up about 4x for me, 4x in the past year, I actually started buying more of. And so Journey subscribers know about that. But that's just one of the perks for Unrivaled Investing Journey subs, where each month I aim to identify at least one potential multi-bagger. I'm trying to find the types of companies that go up hundreds or thousands of percent. Every month, trying to give you ideas for your own journey. I'm sharing what's going on with my journey, but you're going to make calls what's right for your journey. And I'm going to share, hey, I think this company has potential multi-bagger. You go, oh, Daniel, you're being too conservative. I want to buy a lot more of that. That's for your personal journey. My view is I'm just going to share my ideas. What am I doing? And hopefully that's going to be helpful for you. So at least one potential multi-bagger each month. I think this month alone, I've already covered 2 or 3. An educational series, at least one potential educational series each month, teaching, folks ideally how to become better investors, how to think about potential multi-baggers, how to think about margins long term, how do you get these optimized margin levels. Also the full download of my full portfolio on a monthly basis, where you can see by percentages if you want to track my personal journey on a detailed level. And you can see the full catalog of contents below in the description of this video. You just click on it if you want to get your feet wet and just see everything I've posted already. And at the end of the day, and this is the point that I think a lot of people need to focus on, is that just finding one potential multi-bagger can change your life journey. And so if you want to follow my journey as I try to find these potential multi-baggers, go to unrivaledinvesting.com. And as I already mentioned, I will post an exclusive video, it might be a little bit later tonight, on this setup, Berkshire Grey, the SPAC, and what do I think about it, some additional elements in terms of thinking about the risk reward that might make it you'll have to see for yourself. So I'll post that in the comments below. And if you enjoyed this video learning about Berkshire Grey, make a point of subscribing. If you're already a subscriber, I appreciate that thumbs up, and thank you so much for watching.